If you're investing in the UK, you've probably seen all those apps promising easy wealth. Tap a button, pick a winner, and watch your money grow. But here's the reality check. Thousands of investors are bleeding money because of mistakes they don't even know they're making. And I'm not talking about small losses. I'm talking thousands of pounds evaporating from portfolios every single year. So today, we're breaking down the 5 biggest investing mistakes UK beginners make, and more importantly, how to avoid them. Let's dive in. Mistake number 1, letting news headlines control your investment decisions. The media makes money from anxiety. Brexit uncertainty, Bank of England rate decisions, political chaos. There's always something to worry about. If you're waiting for the perfect calm moment to invest, that moment will never arrive. Here's the secret successful investors know. By the time something hits the Financial Times, the market has already reacted. Prices have already adjusted. It's old news packaged as breaking news. Now, unexpected events do happen. Nobody saw a global pandemic coming, but these aren't flaws in the financial system itself. They're temporary disruptions. So, what's the alternative? Stop making investment decisions based on fear. Ask this question. Is this headline actually changing the long-term value of your investment, or is it just noise? Because 9 times out of 10, it's just noise. Remember this? Markets run on 2 emotions, fear and greed. And if everyone around you is fearful, that's actually a good sign. Bull markets don't end when everyone's scared. They end when everyone's euphoric and over-leveraged. Fear means there's still room to grow. Mistake number 2, sitting on cash waiting for the perfect moment to invest. Here's what actually happens. The FTSE 100 starts dropping. You think, great, it's happening. But then it drops more. Now you're nervous. What if it drops even further? So you wait. Then suddenly, out of nowhere, markets bounce back up. And you're still not investing because there's no clear reason for the recovery. The news is still negative. By the time things stabilise and the headlines turn positive, you've missed the bottom and the recovery. A double loss. There's a saying in investing that's been proven time and time again. Time in the market beats timing the market. It's not about buying at the absolute bottom, it's about being invested for the long haul. Think about it this way. Since 2009, we've had the European debt crisis, Brexit, trade wars, a pandemic, and multiple conflicts. People have been calling for the next crash for over a decade. And what happened to the FTSE 100 and global markets during that time? Substantial growth despite the constant uncertainty. All those people waiting for the dip. They missed massive gains that could have been completely tax-free in their ISAs. The same thing happens when markets are performing well. You think, oh, everything's too expensive now. Better wait for a correction. And you wait, and the market keeps climbing. Stop trying to time the market. If you've done your research and identified solid investments, the best strategy is simple. Buy quality assets and hold them. Buy high, sell higher. Not buy low, sell high. Mistake number 3, holding on to losing investments way too long. This one's painful, but it needs to be said. One of the fastest ways to destroy your portfolio is to hold onto a stock that's tanking, just hoping it'll recover. This happens all the time. You buy a stock at £100, it drops to £50. Instead of reassessing, you think, well, I'm already down 50%. Might as well hold and see what happens. Then it drops to £30, to £20, and you're still holding because you're already down this much. Here's the hard truth. Hope is not a strategy. Understanding why a stock is falling is crucial. Is it because the fundamentals have changed? Consider a tech company that thrived when interest rates were near 0. Now, rates are at 5%. That company can't survive in this environment. If you're down 70% and the stock doubles, you're still down 40%. The smart move, cut your losses and reinvest that money into something with actual growth potential. Find structural winners. Companies positioned to thrive in current market conditions. Not companies clinging to a business model that no longer works. Make it a habit to regularly review your portfolio. Be honest. Is this investment going somewhere? Or are you just emotionally attached? Because the market doesn't care about your feelings. This might surprise some people, but sitting on too much cash is actually losing you money. It feels safe, especially when markets are volatile, but cash is quietly destroying your wealth. Here's why. Inflation. Every year, the purchasing power of your cash goes down. If inflation is running at 3 to 4% per year and your savings account is earning 2 to 3%, you're losing money in real terms. That £10,000 sitting in your account, it might still say £10,000, but it's worth less than it was a year ago. Now, zero cash isn't the answer. A balanced portfolio should have about 10% in cash for emergencies and opportunities. But most people are sitting on 30%, 40%, sometimes 50% cash. And that's a massive problem. Why does this happen? Fear. Market volatility causes panic, you cash out, with the plan to jump back in when things calm down. But things never fully calm down. There's always uncertainty, always risk. Meanwhile, you're missing out on dividends, compound growth, and long-term gains. And remember, in your stocks and shares ISA, all of those gains are completely tax-free. Cash sitting in a bank account doesn't grow. Invested money does. Ask yourself this question: why are you holding so much cash? Is it needed for something specific in the next few months? That's fine. Is it because of market fear? That's a problem. Are you waiting for a better entry point? That strategy has already been debunked. If you're holding excess cash that isn't needed for emergencies, you're not being safe. You're actively sabotaging your financial future. Mistake number 5, lack of diversification. This is the classic all eggs in one basket mistake, and it can be financially devastating. Going all in on a single stock might feel exciting, especially if it's the next big thing. But what happens if you're wrong? What if that company gets hit with a lawsuit, loses a major contract, or simply underperforms? Your entire investment tanks. Diversification isn't just a safety net. It's one of the most powerful tools for building wealth. Studies show that the vast majority of portfolio returns come from how you allocate your assets, not from picking individual winners, but from spreading your investments across different asset classes. A smart portfolio typically includes global equities through index funds, bonds, maybe some property exposure through REITs, and perhaps some alternatives like commodities. The exact mix depends on your age, risk tolerance, and goals. But the point is, spread the risk. And here's something that doesn't get discussed enough. You can be too conservative. If you're young and your entire portfolio is in bonds and cash because you're scared of the stock market, you're not taking enough risk. Over the long term, you need growth assets to build real wealth. Diversification is about balance, reducing risk without sacrificing returns. It's not about playing it safe, it's about playing it smart. So there you have it. 5 investing mistakes that are costing people thousands, maybe even tens of thousands of pounds. Stop chasing headlines, stop trying to time the market, cut your losers, put your cash to work, and diversify. Investing isn't about being perfect. It's about avoiding these massive mistakes that wipe out portfolios. Avoid these and you're ahead of the majority of investors out there. If this video was helpful, hit that like button and subscribe for more investing insights. Drop a comment below. Which of these mistakes have you made? This is Sophia Blake. Let's build that wealth.